Welcome everybody to the panel on this Tuesday morning, the last day of 1-to-1. Just by way of introduction, my name is Terblanche, the SVP of Business Development for Ausenco. I'm a reformed investment banker, so I'm always privileged and happy to talk to fellow bankers. Ausenco is a global engineering project execution construction firm. We provide full project lifecycle consulting, study and execution services. We've built some of the more prominent projects in West, East Africa and Sub-Saharan Africa, so a real core focus on this continent. As you can probably pick up by the accent, I'm born and bred Canadian, not really. I love this country and it's always good to be back. So I'm going to start off by not introducing the panel. Nobody can introduce themselves like every individual himself and herself. So I'll just ask each of the panelists to please introduce yourself briefly, if you can keep it brief, and then maybe spend a bit of time just talking about your organization, and in particular, give the audience a couple of examples of recent financing you've done just to set the scene a little bit, and then we'll dive into and start talking about some of the innovations in financing, some of the risks and challenges. So, Harry, why don't you start off?
Thanks very much, and it's always nice to be introduced as an investment banker, as an insurance guy. But I've been at Marsh for 15 years or so, and I currently lead the infrastructure team within our UK business, supporting finances, whether it's debt or equity, and structuring sort of political risk and non-payment solutions to help facilitate that funding.
Thanks, Harry. I'm Posesorski. I'm a principal at Sprott Resource Lending. We are an institutional fund focused on senior secured and other forms of financing for the miners sector globally. We're part of the Sprott group of companies, which is a global alternative asset manager, publicly listed on the TSX, managing about $25 billion. We've been around since 2010, focused on a global basis. The most recent financing we've completed on the credit side would be in West African Resources on their Kiaka construction financing, which we closed in December this year. Thank you.
So I'm Julian Grieve. I work for RMB and am an unreformed investment banker. So we are the resources sector team. We have a focus on mining and metals and oil and gas. And Sub-Saharan Africa is where we play. I think that, people have seen banks become increasingly less useful over time in terms of project finance. And we're more of a player in taking clients to the next step. So projects that are then in a subsequent brownfields phase. And there was an announcement this morning around Kenmare's refinancing of their facilities, which we led. So I think our niche is actually in that kind of maturity of finance more than necessarily the greenfield stuff. And so we can kind of manage expectations and take over from my colleagues around me once they do the hard work.
Nick Farr-Jones, Sydney-based with Taurus Funds Management. For my sins, a former lawyer. I had about a decade in a mid-sized Sydney legal firm before I had interesting invitation to take a young family to Paris. I joined Société Générale, had 4 years in Paris. With the derivatives team, I set up a joint venture with Rand Refinery, bringing doré in from particularly West African countries. We turned around the physical and set it up to India, big consumer of gold, so that was interesting. I went back to Sydney and joined the mining finance team for a decade before being invited to join Mike Davies, Gordon Galt and Rowan Menon at Taurus. They set the business up, private equity business up in 2006-07. We managed a couple of equity funds initially. We raised our money in the United States predominantly, so county, state pension funds largely. The volatility of the equities didn't really suit their appetite for resources. So about a decade ago, we switched into what a lot of us had done professionally, which was debt finance. So we managed about $2.5 billion US dollars. We typically do lending in precious and base metals, metallurgical coal. We don't do thermal. So there's a big space in the coal financing, particularly in Australia. So the Met Coal region is the Bowen Basin in Queensland, where we've done a lot of transactions. Here in Africa, we've probably done $1.25 billion of debt financing in particularly West Africa, of course, the prolific beryllium gold belt. Countries such as Burkina Faso, Mali, Guinea, Ivory Coast. Typically, we like to do project and acquisition financing. So we've done probably 8 transactions ranging between 130 million US to 220 US. We can do bridging finance, which we've done quite a bit of. We've currently got a 35 million bridge to Robex, which is tied to a 115 million project financing when the CPs are satisfied. We've also recently created a royalty fund, so that's been going for about a year, and enjoy the conference and have been coming here for a long time, since '96.
Hi, good afternoon, everybody. Taiwo, Okwor. I am a vice president at the Africa Finance Corporation. The Africa Finance Corporation is a multilateral and development finance institution, and one of the few institutions still able to deploy capital on the continent. In terms of what we do, the core mandate is to invest in infrastructure and close the infrastructure deficit. So long-term value and sustainability and development is one of our key focus. In terms of notable transactions that we have done, AFC was a lead bank financial advisor to the Baomahun gold project in Sierra Leone, and this project is going to be the first commercial gold mine in Sierra Leone. It's going to have a huge amount of economic and development impact. In terms of what we're able to do, we're able to deploy a number of instruments, which we believe is key to being able to galvanize the mining sector on the continent. We invested the senior debt, mezzanine, and also stream, which is very pivotal because a number of mining projects in Africa get stuck and not able to move forward without early stage capital being able to to complete key development milestones. So we've done that on Baomahun project. We're looking to do that on a number of other mining projects, and we also pursue an ecosystem strategy as well across the continent. I think the key benefits of an ecosystem strategy is that you're able to focus in the mining from the pit to port strategy. We are one of the few institutions able to invest both in development of the mining sector and the key infrastructure to enable the mine to function on a sustainable basis. Thank you.
Thanks, everybody. And I think, as you can see, we put together a panel here of traditional, non-traditional finance sources, the risk side, infrastructure side. So I think a great number of people here and to talk about a lot of relevant topics. So before we get into maybe talking about some of the challenges and ESG in particular and country risk in particular, maybe start on a bit of a positive side. From your recent dealings and interactions, not just here, but generally with your client base, which parts of Africa and which commodities get you most excited for the way that Africa is positioning itself to play a key role in the supply side, not just of critical metals, but also precious metals? So which parts get you most excited? Harry, maybe you can start.
Thanks. Well, I suppose from a risk and insurance perspective, we sort of support projects in a number of different sort of minerals and resources, etc. And where the ones that we have supported at the moment are sort of in Togo, Burkina Faso, Mali potentially, as well as looking at Senegal, and we're sort of structuring solutions in each of those jurisdictions despite the turmoil in a number of those markets. And whether the underlying resource is lithium or nickel in Tanzania, gold in Mali, there are still insurers willing to support businesses with a good business case and underlying partners, and where the deals are well structured. And so I think despite some challenges, there are some real positives in that there's an international community looking to support the lenders to those projects.
Yeah, from our perspective, we see a lot of opportunities across Africa. We know we don't have a very specific view on which jurisdiction. We obviously look on an opportunity basis. For us, gold has been historically a focus, obviously coming from Sprott as the organization that's first, and now obviously from uranium, that's a big part of our business from the asset management side. But we see obviously uranium, we're constructive long-term there, so we're seeing a lot long-term, and notably in Africa, there's some excellent projects. For us, why Africa has been a focus is, being situated in Toronto and seeing some of the difficulties of building a project in the Americas compared to what you've seen historically and in Africa from on time, on budget, and meeting operational parameters, which is becoming more difficult in the Americas, is despite maybe some of the volatility that you see in some parts of Africa, we think it's in circumstances can be more attractive than what we're seeing in Americas. So for us, it will remain a top area to kind of to invest from a credit perspective.
So we're probably a little bit more boring in terms of where we play, and that's the names that you would expect to hear from a bank. So Zambia, Ivory Coast, Senegal, and then some of the more interesting ones, personally, I think are the kind of unloved countries from a few years back who've turned around in terms of course, and Tanzania is really on the spectrum again. Some great attention in the country, some phenomenal resources there, and the DRC is somewhere that you can't afford not to play. So we're putting more attention in there, and really keen to keep an eye on Angola, who's turned things around, has great prospectivity, massively underexplored, and a much more conducive environment from the regulators, from the approach to government. And we're keen to see what happens there in probably more of a 5-year plus time horizon. Commodity-wise, couldn't agree with you more about uranium. I think that's just come from behind and taken a lot of people by surprise. And keen to see if that turns into projects before a bubble bursts. But it seems like this one's going to run for a little bit longer.
Just on country risk, having had time at Societe Generale, we're fairly comfortable with Francophone Africa. So that's where we've done a lot of that project financing that I spoke about. I'd agree with your comments on Tanzania. I was lucky enough after the conference last year to do a site visit. We went to the Nyanzaga project just off Lake Victoria for Okwor. Unfortunately, my technical team weren't totally comfortable with the underground ore body, so we didn't end up putting a term sheet forward. But since the change of, the president, there's been a massive change. And, other countries in West Africa, we've seen some issues and go backwards. And generally speaking, we will go naked without PRI, but from time to time we will look to take that, and covering the various risks is part of the challenge. But depending on the country, we either will or will go without political risk. We've found that precious metals, typically easy processing, good, strong resource with and reserve and mine plan, typically open pit, is easy, far easier to finance. Obviously, management's critical. We all know that, and also the quality of the feasibility work is really critical to our team. And sometimes with those bridge facilities that I spoke about, the CPs to draw down under the project finance will have a lot to do with not just permitting, but often the quality of the feasibility work and additional work that our technical team might require to get comfortable. So that might be a 6, 12, even 18-month process. Might involve some additional drilling or spacing of the drilling. It might involve some more met work to get us comfortable, but we might be happy to do a 10 to 40, $50 million bridge, which is tied to the project financing. We had a bad experience in the DRC, so we probably won't go back there. It wasn't so much a political risk, it was more a technical risk. It was a copper project, so once bitten, twice shy. I didn't mention too, after I mentioned we've done a lot of met coal in Australia, we also do industrial minerals, so we're very comfortable with the suite of fertiliser products and also in mineral sands. So yeah, that's generally what we look at.
Okay, thank you. I think for us as a DFI, we see as critical to our role to invest across the continent, right? And in terms of what we've done in mining, we've deployed close to over $1 billion across a number of countries, and we've invested in precious metals, bulk, and also very keen on the battery metals as well. I mean, we're not shy to go to new jurisdictions or new countries. We see ourselves as a solution provider. I think in Africa, things never go as expected, but we see ourselves being able to play a significant role by, forming partnerships with governments in order to, create the right solutions. We are doing, we're forming partnerships with, a number of governments like Nigerian government, because we see that's one of the key ways to be able to galvanize the sector And the rationale for that is be able to, work alongside, the government to invest in early stage projects. So the government, for example, the Solid Mineral Development Fund in Nigeria, will come in as a co-financier to invest in exploration, while an AFC as a DFI will come in and provide the development capital. We're looking to scale and replicate this model across the continent. So you see more of the strategic partnerships across in a number of countries. So in summary, AFC has 43 member countries, and we do tend to invest in our country members because we see as a big contributor to be able to develop those in those countries. So very much open for business, so all across the continent.
Very good. Well, Nick, you brought up country risk, and I think we've seen geopolitical risk take on a whole new dimension across the world. And in particular, there's parts of the African continent where geopolitical risk and interference from foreign governments is quite topical. So I'm sure from a lending perspective, country risk is top of the agenda for everybody. And I think, Harry, you've seen on the Marsh side quite a bit of innovation in that area and different ways to address that risk.
Yeah, thanks. So when we think about speaking to our clients, we're really trying to help them overcome some entry barriers into market, and clearly country risk is top of the agenda when you're looking at a number of the jurisdictions that we're talking about today. And so if we look at the Marsh world, we have our sister company Mercer, we have Oliver Wyman as well in between, as well as Marsh on the broking side. We have a depth of knowledge between those institutions, whether it's advising funds of around, I think it's $80 billion that are infrastructure linked, and Oliver Wyman's consultancy and Marsh's insurance broking data. We sort of get our heads together and think, well, how can we link capital to projects? And so two of the initiatives that we have launched recently is the Sustainable Markets Initiative and the Catalytic Investment Exchange. And that's for projects to be loaded up onto a platform that then is linked in with capital providers with typically sort of low investment returns that are looking to get into this space where they've identified a strategic reason to do so. And then we use some data-driven sort of analytics that we've put together around measuring country risk in a more tangible way for investors to understand. And so that piece is where really sort of my expertise comes in around sort of how do we think about country risk and how do we price it in effectively. The use of sovereign bond spreads or CDS pricing is not really a relevant benchmark for the markets that we're going into. They're very difficult to understand at a project basis. So how do we actually price that in an efficient way and communicate it to investors or equity or debt in order to get the price right and to encourage investment? And so we put together with S&P Global the country risk investment model, and that effectively, without going into too much detail, prices 20 country risk events that they define. So whether it's tax implications, whether it's availability of local labour, whether it's export conditions, whether it's availability to get licenses or breach of contract or legal risk. These are all individual buckets where a defined probability and that probability on impacting future cash flows is quite carefully calculated. And so investors can get a much better sense of the risk profile that a particular investment in a particular industry, in a particular sector, in a particular country is running. And the idea is that they can get a much better assessment of the hurdle rates of return that they need to drive in order to get into that country. And then the second piece to that would then be to overlay any mitigation that you have in place and factor down those risks so that you can have an adjusted hurdle rate that really reflects the mitigated investment risk that you're running by assessing the risk accurately and then overlaying the various insurances, whether it's tax insurance or political risk insurance that covers some but not all of those events. And that really just helps our clients have a narrative and create a narrative that's more adjusted to the investment itself rather than the country. And so by breaking down those barriers, we tend to help our clients access additional pools of capital at cheaper prices, which tends to help facilitate investment.
Yeah, I think, obviously from a lender perspective, obviously country risk is obviously that, and on the technical side are the two first things we look at when looking at opportunities. And we obviously look at it with the same lens across the globe, as is, each jurisdiction has their own different nuances. And I think for us, what we've learned is, rather than looking at kind of perceived risk, as trying to really understand on the ground what the risks are in the specific country. Our most recent experience in Burkina with West African is, looking at, obviously what's the perceived risk of what you see from the press and what you read, and trying to really understand from boots on the ground will kind of help you give a better sense of what the risks are, from a mining perspective, from the taxation, royalties, and social license, to also from the political standpoint. I think that's important in how we, evaluate risk. And, we had the benefit of partnering with Chorus Bank on that financing, and obviously leveraging their experience in country and boots on the ground was really helpful for us. And we kind of try to use that in every country, being in Africa, or if we're looking in sometimes in the Americas, such as Mexico, and can be very specific to where your project's related. So it can be, we spend a lot of time on that rather than just using, one size fits all kind of criteria for these jurisdictions.
So we probably use the insurance product a little differently to some others, in that for us, it's a way of being more meaningful in terms of our ticket size. So if we had $10 of appetite for a particular country, we try and use the insurance to enable us to take that to $40, for example. But it's not a go, no-go decision. So if we wouldn't do the risk on a standalone basis, then we wouldn't do it on an insured basis either. And I think what we've seen is that we're particularly sensitive around reputational risk. And so for a listed bank, you don't want to be in a place which is known for being corrupt and where you have a regime that's suppressing human rights and that kind of thing. You can't really mitigate against that risk. And our best tool is to stay away from those. And then in other regions, it's client selection. So how does the client or the mining company engage with the government? And their relations are key to their sustainability. Because we've seen that a lot of these political risk events are not targeted at the entire industry necessarily, but you have a couple of targets who have bad blood from years before and bad relationships. And if you can avoid those entirely, you can avoid big losses.
Yeah, I'd agree with all the above. I mean, Harry, it's important that lenders have a very good relationship with their insurance providers and stay very close to them and have long and deep discussions on what they're seeing in country. I'd agree in relation to the potential client's relationship with government. I spent two nights in Harare. Before coming down here, I think for the first time for Taurus, Harare is probably open for the first time maybe in 15 years. It's a country that I think has also been improving, and for me it was important to get a window to meet some of the ministers and personally meet them and I'll ask a bunch of questions. I also find it's useful in African countries to try and get to know either our Australian ambassador. So we've got a Department of Foreign Affairs and Trade, which basically is global, and to get to know your Australian ambassador and ask a lot of questions, and how long have they been in country and what are their relationships like with government, and what are they seeing. And so I met our Australian ambassador in Harare as well. They're sort of things that are a little bit different, but we find it sort of comfortable on getting on top of various issues. One of the things that we're finding very difficult, particularly with the state of the equity markets, is, can we, alongside debt, do some equity? And the answer is yes, we can. It has to be tied to a debt financing, but being able to provide some equity to a lot of companies that have had their market caps bashed up in the last sort of 12 and 18 months, I think is becoming important. And just in recent months, those of you who are Australian, you've probably heard of Regal Funds Management. My daughter works there and we know the guys very well, but they've recently bought 50% of the equity of Taurus at the top level. And so it's a relationship which is only just starting, but we know that they're very keen on resources as well across a whole range of fund structures, but they like resources, so we're hoping to work closely with them. And yes, they can write a big equity ticket as well. So if there's high conviction on a particular project, I think we now have the ability to do some big equity tickets too, which can be very useful for the clients, because typically, you don't want to over leverage on a project, put pressure, particularly when the project is commissioning. So as you probably know, 50-60% debt on the total capex envelope is what you'd typically look at. But when market caps have been bashed up, it sometimes can be very difficult for a non-producing junior company to actually finance the full development. So being able to provide some equity alongside the debt, we found is quite important too.
Okay, I think my fellow panelists have got it all covered, but I wanted to just add some perspective, from the geopolitical and political risk point of view from an AFC, which is a DFI. I mean, like we all know that, unexpected things do happen, but it's about being in a position to be able to, to handle those risks in a very, very manageable manner when they occur. So a good example is, the recent, coups that's happened in a number of African countries. We as a, DFI, were invested in Gabon. But I think what actually worked for us, the fact that we have a very strong, relationships in country with the government. We actually have investments that cuts across a number of sectors in the country. And you can imagine that when the coup happened, there was a big concern as to what happens next with respect to investors coming to the country. But I think given the strength of the relationship that we have, on ground and, all across the continent, it was quite helpful to be able to engage and to be able to not to have a lot of concerns, because it was business as usual. But from an external point of view, there was a sense of panic that, things are not going to go according to plan. In Gabon, for example, we invested in, manganese mine smelter. We invested in port. We invested in the rail. So an ecosystem of, infrastructure in one country, which amounts to extreme amount of capital. So I think to your point, it's about the strength of relationships, the sponsor, the quality of the sponsor, and in certain instances as well, we would, take insurance, but on a very selective basis.
Yeah, I think just to add to that, so I mean, really good point, and something that we've been seeing in terms of trends for mitigation. I think mining is one where, on the funding side, I think the partners are a bit clearer, but whether the Americans and DFC and the IFCs are quite so, or have been less concerned perhaps than they might be going forward. But on the mitigation side, it's typically private markets that will take the reputational risk that might be associated with a number of mining investments. And I think we're seeing a change. I think the partnership approach with multilateral institutions, not just on the lending side, but on the mitigation side, is a real theme, and something that we need to probably work a bit harder at aligning with what the mining sector is trying to do, particularly in the key transition minerals. And so we supported a key multilateral in Africa that isn't the esteemed AFC, but we helped them launch their guarantee platform, which is effectively a political risk instrument, but it absolutely uses that leverage where you can, the idea being that you can help work in partnership with these governments before it becomes an issue, rather than relying on a claims payment to make your shareholders happy. And I think that's going forward, particularly where these projects are of a particular size and a particular capital requirement, that these key African multilaterals will play a really important part in leveraging the most optimal solution from a risk mitigation standpoint.
Thanks, Aaron. Maybe a bit of a deeper dive on the topic of equity markets, and Nick, you brought it up. We all have seen what a dire state the equity markets are in generally. Liquidity is very thin. Every time a good piece of news gets published by a company, they put out a good feasibility study, mostly done by Ausenco, the share price goes down because that's a liquidity event. So I think all of you talked about the various financing sources, and particularly debt and royalties. None of those can exist without equity. So maybe particular for Julian and Taiwo, who are based in Africa, where do you see the role of local equity markets and we know perhaps don't have the depth to finance a full project. But where do you see local equity markets fit into the financing side of particularly mining resource projects, and given the benefits it holds for the local communities?
Thank you. I think great question. I was at, I think it was toward the end of last year in London, the Mines of Money, and a similar question came up about what's happening to equity market. I think the current conventional was clearly broken, right? And we need to find, alternative ways to look at it. I guess I want to flip the question a slightly different way, that maybe the equity investors, the equity market is looking for something else. Right, so the typical way whereby the junior miners go to the market to raise equity is not the model that needs to work. And there are some lessons learned in recent times, in other jurisdictions, whereby people have been, investors have been burned, and they don't necessarily feel they are being compensated adequately by the equity market. So it's one theory, right, as to why the market is not responding to, a number of the, announcements and equity capital raise that is out there. So that's one theory. But to your question, you're right. We need to look for or think about creative solutions to be able to galvanize the market, because without, the investment and funding, exploration, early stage development, the projects are not going to come online. And given the demand for, battery minerals or even the precious metals, there's a huge amount of capital that is needed. So what we're doing, I'm going to speak from my own perspective, which is, as a DFI and trying to mobilize capital on the continent, is this co-finance model whereby we work alongside a strategic partner who puts in the early stage, development capital, and we will come alongside them to provide project development capital. And the idea and the rationale for that is to be able to get the project to a bankable state. So essentially, we're increasing the pipeline of bankable projects that would then make it attractive for other financiers or the capital providers to come along to invest in the project. So that's one thing we've done as AFC to be able to fill the gap. Essentially, there is a challenge here. How do we close that gap? But on the other, and the second aspect is also the fact that I think African institutions need to do more and lead by example as well, to be able to put in more sources of financing to work, as opposed to relying on international capital. I don't have a solution to that, but I think that's one of the things that is going to, to be able to lead the way with respect to attracting capital into the sector.
Julian?
So I think everyone would be disappointed by equity markets and their support for mining projects. And it's difficult because it's to some extent rational. And if you look at the biggest mining companies, they've got market caps of $150 billion, right? That's kind of capping out for mining. But that isn't too different from what it was 10 or 15 years ago. And what's changed in that time is that you've now got companies like the Magnificent Seven who are all over $1 trillion market cap. So it's just that much harder for an asset manager to spend the time and energy researching mining for a very small investment in their portfolio. So kind of asset managers, I don't think, are the answer. And where you raise good capital for mining projects is where you've got a really strong retail base. And I think local markets, particularly in the African continent, don't have that. So we've got to, as an investment bank, we've got to work with the exchanges to try and up that story and increase that access. But you're not going to see significant wealth coming into that market until there is significant wealth in the retail base in that country. And that's a big problem for Africa. So we probably have more success in searching for private capital to come into companies and develop projects than in approaching a stock market trying to sell a story for a particular project. And so it's other mining houses and high net worth individuals that we've seen stepping in to some extent to fill that gap, as well as the structured funds. And I don't really see that the local exchanges are going to be a meaningful contributor towards project development and value re-rates in the foreseeable future.
And I don't think it's an uncommon problem to mining. If you look at power, if you look at other key sectors, it's still the costs of development and equity, perhaps in power, are a little larger than mining per se. But philanthropic capital or development finance capital, whether it's funded through partner institutions, is still very difficult to access in order to get the project permitted and licensed in the right way and developed for project finance or further investment. And whether local pension funds have a role to play in perhaps that value chain, I don't know, but it's a difficult question to ask.
Just a couple of other quick random thoughts. I mean, obviously, companies will look at other means of accessing finance rather than the huge dilutionary impact of raising equity at the moment if their market cap has been beaten up. So obviously looking to sell a royalty, but that has its challenges because project financiers don't want a company or a project loaded up with royalties. In some countries too, in Africa, you'll find that you won't be able to register, the buyer of the royalty won't be able to register the actual royalty against the tenements. And so if the project changes hands, royalty might disappear. So it's very critical that from a legal perspective that you're able to register on the title of the tenements, the mining tenements, your royalty. We haven't talked about the role of the big trading houses. I had a beer on Sunday night with a good friend who's done extremely well in Zambia, and he was able to get $150 million US dollars of finance out of one of the big traders. You probably know who I'm talking about, but it's a whole suite of people that sometimes have to come to the party, providing different solutions to getting projects developed. And of course, you've got to look at the cost overrun aspects as well, particularly in the inflationary environment that we've all lived through in recent years. And so, again, that can be a challenge because typically it's 10, 15% of total capex. So a lot of things that you've got to deal with. Of course, the streamers can come into play, but again, you can't just overload a project with too many commitments to various players. Got to be conscious of the amortisation of that senior secured facility.
All right. Well, maybe we can turn a little bit to the topic of ESG and particularly community involvement support required for moving projects forward. I think we've obviously all seen First Quantum and the troubles that they got into in Panama. Still amazing that the copper price isn't reacting to that. But do you, from your perspective, see ESG in the African context any differently from the way you view and evaluate whether companies are doing the right things under that, let's call it that banner of ESG? Do you think Africa should be treated differently? Do you treat it differently? Or how do you evaluate the impact positively and negatively of doing good or doing badly by ESG? Maybe Corey, you can start.
Yeah, sure. I think from our perspective, we use the same criteria across any continent or jurisdiction, not just Africa. From the ESG perspective, I think it's hard. Every jurisdiction is a little bit different. I think we spend a lot of time, as I said, boots on the ground of understanding the social license to operate, the relationship with the communities and indigenous, and spending a lot of time on that and understanding. And it's very specific to each project we look at. At a high level, I think, the Equator principles and looking at gap analysis and working with the management teams on, how they're going to maybe address things is kind of a good starting point. But obviously every country and area within that is, specific nuances of where the project's going. So it's hard to have, a one size fits all for ESG. And I think that, you can't ask some companies to adhere to certain things that don't really make sense. So we try to take a very pragmatic approach to, having a positive impact from these projects of wherever they're located. We use the same kind of methodology for looking things in South America or Asia, and we do the same within Africa. And it's an evolving on the ESG side as we go through it. I think most of us here, it's always been part of the due diligence process for evaluating financing projects, where it's maybe more front and center now than it has been, but I think it's always been part of it. And most of the companies we look at are publicly traded, which have, requirements from that side. And I think that side will, continue to evolve. And I think there'll be, more standards that, people can look to evaluate projects from an ESG perspective.
I'd chip in and say that in Africa, it's more important than in most other jurisdictions to get the ESG aspect right. I think a large part of that is just impact. Right? So if you're building a mine in Mozambique, it's much more important to the country, has a much bigger impact on a community than if you do so in Nevada. And so you're in the spotlight and you have to do the right thing. And we generally see companies do that. So I think where we really need to work as an industry is in telling that story, because the mining industry has dramatically transformed over 20 years. And we don't talk about that, or at least not broadly enough. And there's still this suspicion from a lot of governments that it's an extractive industry, that it's exploitative. And we need to change that narrative. And perhaps that'll also help solve some of the equity gap.
Just very quickly, I mean, Corey mentioned the Equator Principles, World Bank standards. It is important that companies are compliant, but I think, as Corey mentioned too, I don't think, well, from our perspective, they don't have to be compliant on day one. But you work towards it and you make sure that it's a big focus of your management, and it's something that is regularly updated in meetings and sort of monthly updates, that management is focused on being compliant, but they might start at 80% compliant. On day one, you want to see them get to 100% in due course. And I think it's great when companies leave a legacy. When I was in Harare, I'm on a trust back in Australia. A Zimbabwean friend tragically lost her son 15 years ago, and it's been a long time coming, but I was delighted to go out in the outskirts of Harare and see that the school that I'm involved in is sort of half completed. I think it's great when mining companies in the industry leave legacies in communities. And sometimes I wish that we, the financiers, would do more in that space as well, not just the mining company, but I don't run the place. I just try and persuade my mates to maybe do a little bit more in that space. But then again, we've got LPs or investors that have got their hand out as well.
Just to add to what my fellow panelists have said, for us as a development finance institution, ESG, E&S, sustainability is core and a key component of what we do. But I think the key challenge at the moment with the industry is the fact that there is a rise in demand for battery minerals, increase in outputs. They need to take account of the effects of climate change, at the same time balance that with the need to be profitable. So there's an increasing increasing demands, and companies are looking to determine what's the most optimal solution for them, because I don't think we've ever faced this mix of challenges before. But I think what companies, sponsors or company needs to do is to focus on long-term strategy of maintaining that license. The social, you talk about license to operate. I think it's about determining what their own optimal license to operate should be. So for example, identifying what the key key needs of the community is, as opposed to what they think the community needs. Early engagement, stakeholder management, and trying to define that on a long-term basis, as opposed to what it takes to deliver a mine now and increase production.
Maybe a final question. There's a couple more topics, but I think we're going to run out of time soon. Maybe just the final question on when you get deals pitched to you, and particularly, I guess for all of you, if a CEO sits in front of you or a government sits in front of you and trying to get a transaction over the line, what is the key things that you want them to focus on? What is the key pitfalls to avoid, mistakes you've seen made that really just starts the conversation on the wrong foot, and the CEO is never going to recover from that? There may be a couple of people in the audience that have gone through those experiences. So what are the do's and the don'ts, if you like, when you have that first interaction with the CEO and looking at a transaction?
So I suppose just for very quickly, from an insurance standpoint, the legal framework, we rely as brokers and insurers on there being an underlying a good commercial case for the extraction and the market pricing of the minerals, but a robust framework that provides recourse for the investors subsequently in the event of a government action or inaction is crucial for us to structure the right type of policy. And we can be very flexible around how sort of royalties and hedging for pricing of of resources. But ultimately, the robustity of the legal framework is really important for us.
I think for us is understanding who's behind the project, the team, their core expertise, because I think there's a difference between people who've developed the project versus people who are going to manage the project on a long-term basis. So it's really getting the comfort around who's going to run the project. When challenges do come, are they the kind of people that you're able to get across the table and have very good conversations with? So I think aside from the technical aspect, the team is very core for us.
Yeah, just quickly, it's quality of the management. I think having the right people in the right places, and obviously as projects evolve, those positions can change, but experience is critical. For us, the quality of the feasibility work is critically important, and also the ability for what I'd call a win-win situation. Our best clients are ones that know that we have to do well, but we know that they have to do well. You have to be flexible. Not everything goes well. We know that in the mining space. So that importance as an alternative financier of not having your client put to the credit committee because things have gone wrong, that you can be flexible. Maybe you extend the amortization period. There's a whole bunch of things you can do, but try and create a win-win culture between client and financier.
I'll end off by saying that I agree with all of those filters. And the one thing that we'd encourage the clients or potential clients to consider is that debt is a little bit like an opioid, and a little bit can make you feel good, but too much will kill you.
Good one. Corey, final word from you.
Yeah, I think everyone's hit the key points. Obviously, as we said, management's critical in their experience. Putting aside on the technical front, engagement locally, starting early. Stability agreements, all these sorts of things are kind of the first pass, and obviously critical as we move forward, and that management has a plan and to address those risks and start early engagement with projects, even before a PEA. Those conversations and engagement happen because it'll just make the process to ultimately getting to breaking ground that much easier.
All right. With that, I think we're out of time. Thank you very much, panelists. Great discussion. Thank you, everybody.
Thanks.